Hello guys, what's up everybody? It's your girl Terry and welcome back to my YouTube channel, an awesome channel where we motivate, give hope, inspire, talk about the journey to the USA and share the opportunity that we get. And guys, if you all remember about my last video that I said I'll be talking about how people in the USA generate future wealth for their kids, and I promised to bring someone to talk about that. And here today I have one of the person who will be taking us through, and I want to introduce you to him as he take us through how that one works, so that when you come to the USA, or if you are already in the USA, you can make informed decision based on the advice that he will give. Hi Onyika.
Hi, Terry.
It's good to have you today. Thank you so much for honoring this invitation. Please introduce yourself, tell us who you are, and yeah, we continue.
All right. Thank you so much, Terry, and I appreciate you having me in your YouTube channel. So, my name is Onyeka. I'm a pastor. I'm a data analyst, and I'm a licensed independent financial professional.
It's good to have someone who can share with us. So please, the floor is yours. So continue from there. I'm going.
So, like I said, my name is Onyeka, and I'm a licensed independent financial professional, helping to educate families on how to manage their finances and prepare for the future. Because most times the challenge we're having here in the state is that most times people retire and yet they go back to work. Why? Because they didn't have enough finances saved up for their retirement that they can live off of in order to have a better life. So here we'll be tackling fighting financial ignorance, financial miseducation of the middle class, why 95% of Americans end up poor and how to fix it. So here are the different companies that we work with. We work with Pacific Life, Prudential, Transamerica, American Fund, Nationwide. So these are most of the companies we are working with. And these are the services, the financial services these companies provide. So I don't know if we have heard about Million Dollar Baby. So basically, Million Dollar Baby, this is what the affluent use to prepare the financial to prepare finances for their children when a child is born at and the child is age just 2 weeks old. The affluents, what they do is they open a financial portfolio for their baby and save up finances for this baby, so that when the child is up to the age of going to college, the baby doesn't have to go to he doesn't have to apply for student loan anymore, because the parent has made preparation for that. So all they need to do is they can select any college of their choice, be it Harvard, be it Yale, be it whatever college that they want to go for, and any profession they want to go, even though it is up to the PhD degree, they can do that. Why? Because the parent has made preparation for that ahead of time for the kids. I don't know if we've heard about IUL. So these are other services. We have IUL, FIA, legacy planning. Legacy planning is, I want to explain on that point. Legacy planning. Most of us that, more especially most of us that came from Africa, we came here looking for greener pastures. And we came here with the purpose of, seeing greener pastures and helping our loved ones so that they don't pass through, the challenges, the difficulties we encountered, growing up or moving down here. So for that reason, we want to set something, we want to prepare something in place so that when our children are growing up, they have something now to fall back on. This is exactly what the affluents are doing. When their child grow up, they don't know what is struggle. Why? Because the parents prepared, they prepared financial backup for them. When they grow, the moment they grow up, they already have something to start living off of, because the preparation has been done. And this is what we don't know. That's why this information is here. Also, I don't know if we've heard about a Legacy Shield. So basically, Legacy Shield is most. This is, I would describe it this way. most of us have properties. We have stuff that we have on our own name. But the problem is, how do we transfer it from ourselves and to our beneficiary or to our loved ones? If we are no longer there, how do we transfer these properties to our loved ones? It's always difficult because if not proper transfer is made, your child or your beneficiary ends up paying 45% of the same cost of what it costs you to acquire the same property, even though you have finished making that payment. See, that is the challenge. That is one of the services these companies helps to avoid. Another thing I want to talk about is the Everest. This is a big deal in Africa, among African communities. We all know that when any of our loved one passes away, what we do mostly is we do contribution, or we do GoFundMe. Why? Because we want to help the family of the deceased, to help them either move their corpse back to Africa for burial, or to help them with the burial planning or burial process. But this Everest will help. What this services does is it provides the family of the deceased. It provides them with 20, I think $25,000, 20, I think 24 or $25,000 to take care of their loved one's burial funeral. I don't know how good that sounds. You already have a system in place that will give you $25,000 to take care of your loved one, instead of doing GoFundMe or calling families and friends to make contribution. See, this is what we have been missing, and this is why this opportunity is something that you want to take advantage of. So these are just only but a few. There are still many more services that they offer that I can't go about talking about right now because of time.
I have a question on that. Are those services for people in the US only, or other people from different country can apply for this?
That's a good question, Terry. So basically, these services or these benefits are only, to the best of my knowledge, is only applicable to those within the United States. I think the company is making plans to extend this benefit across the border, but for right now, I think it's only applicable to those in the United States. But the good thing is that whoever becomes your beneficiary, even though they are living out of the state, once the person in question, the person who has the policy, once he passes away and his beneficiary is living in other country, the government can give that person access to come to United States and claim this benefits as a beneficiary. I don't know if I answered your question.
Yes, you did. Thank you.
All right, moving on. Now, financial principles of successful people. These successful people, there are so many things that come to their mind when they think about where to keep their money or where to invest their money. Here are 10 principles that they consider, and we'll be looking into it briefly. The first principle says, make money but never lose money. I want us to remember this point because it's very, very key. Make money but never lose money. See, point number 2 says, never forget rule number 1. That's to tell you how valuable that rule number 1 is. We all know Warren Buffett. He made the same statement. He said, never lose money, never forget rule number 1. Excuse me. Management versus no management fee. Do you manage your money, or do you pay someone to manage it for you? Inflation is 3%. We all know that the value of money depreciates every year by 3%. So how do you manage your money? When the value are depreciating, then cost becomes what? On a high side. Avoid double taxation. Many pay double taxation, but they don't know. Flexibility and liquidity. How easy do you have access to your money? Compound interest. Social security, critical and chronic illness. This is the number 1 cause of poverty in our country. How do we avoid it? Nurse estates and the probate court. So these are the 10 factors the affluents consider before investing their money. Now we'll look into them one after the other. So before we move forward, if you are living in America, definitely your money will be sitting in one of these buckets. Either it's in your checking account, saving account, CDs, 401k, IRA, Roth IRA, stock, annuity, life insurance, bond, college fund, social security, pensions. So the last point, number 14 says Njangi, Susu, Partners, Wemu, Chama. These are ways we, the Africans, we used to more like make money. So basically, this name is something we apply in different countries. So basically, what it means is that most people come together. They might be up to 5, 10, as many as they can, or even 20. What they do is they contribute money and they give it to one person every month. So they agree on contributing maybe $20 or $100. They contribute and they give it to one person. The next month they make the same contribution, give it to the next person. So in this same way, they just make contribution and share money among themselves. But does it mean that the money is growing? We'll find out. Okay, now the 10 points. This is the first one: make money but never lose money. You see, every account in green, every financial portfolio in green, you are not losing money. You see, something like your checking, savings, CDs, you're not losing money. Index, annuity, life insurance, municipal, you're not losing money. But you see accounts like this, like your 401k area, stock market, stock, Bitcoin, college fund, you are losing money. And one will ask, how am I losing money in this account? Guess what is happening? When you put your money in this bucket, what is happening is your money is being invested into the stock market. And what happens in the stock market? Does it grow constantly? Is it growing constantly? When you look at the chart, you always see it rise and fall, rise and fall. That means you make money, you lose money. You make money, you lose money. So it's not guaranteed if you are actually making money. So paying financial advisors management fee. The account on green, you are not paying anybody to manage it for you. Something like your checking, savings, CDs, index annuity, life insurance, municipal bond, you're not paying anybody to manage them for you. But you see account on red, you are actually paying somebody to manage them for you. With 401k, you're paying 2% to your manager to manage it for you. IRAs, Roth IRA, you're doing the same thing. Stock market, if it depends on which of the stock market you are doing. If you are trading on the Wall Street, you're definitely paying a manager to manage it for you. But if you're doing what we call bootleg, that is, you have it on your phone, you're trading it on yourself, you're not actually paying any manager. But are you guaranteed? That we don't know. Moving on, we have inflation interest rates less greater than 3%. Like I said earlier, what inflation does is that it depreciates the value of money, decreases is where there is more money in circulation, more printout of money in circulation, pursuing what fewer items. So, and every day, every year, the value of money keep depreciating. Take for instance, I can use myself as for example. I know when I moved into an apartment 2018, when that apartment, the cost or the rent was around 720. But guess what happened in the year 2019? The money increased. It increased to 850. It never stopped there. 2020, it increased to 1,000. You see, that is to tell you that the value of money keep depreciating and the cost, expenses keep being on the increase side. So now, how are you making up to that? Those who have their money sitting on a checking account, saving account, CDs, is your money increasing to meet up with inflation? Definitely no. How about 401k area, Roth area, stock? Today you make money, tomorrow you lose money. How do you measure if you're meeting up with inflation. That we can tell. That's why it's in yellow. But you see, account here on index annuity, life insurance, municipal bond, your money is actually growing here by compound interest, which means your money is adding value and you are meeting up with inflation. So even though the inflation, like currently, we know what is happening, the inflation has gone up to 7%. And your money, is your money growing likewise to meet up? It depends on where your money is sitting. Taxes or no tax on interest. You see, every account here on green, you don't pay taxes. But you see, account here on red, you pay taxes. Somebody will ask, oh, I have checking account, saving account, CDs. How do I pay taxes? If once your money is above, I think above 150 to 200, the banks will use your money for trading. They use your money, they invest it into a third party, they make money off of it, and guess what? They give you interest, they give you a portion, they make the lion's share and they give you ant share. And guess what? They add, I think around uh, usually around January, February, they will serve you what we call tax documents. You file for tax, you pay taxes on those interests that the bank gave you, even though they are as low as 2% or 1%, you still pay taxes. And that's what we call double taxation. You pay tax when in your workplace you are being paid salary, you pay tax, and in the bank where you're supposed to grow your money, you still pay taxes. That's double taxation. Who is losing? You are losing. So 401k, one thing with 401k is it's a deferred payment. You don't pay taxes now, you pay tax in the future. Now, let me ask you, will taxes be lesser in cost, or will taxes be cheaper in the future, or is it cheaper now?
It's going to be expensive. But one thing I didn't know is that 401k is taxed. For those people that don't know 401k, most of the company give the benefit for the retirement. So they give, maybe Onika can explain on that more and how the taxes for 401k is taxed.
Absolutely. So, what the company will do for you, in fact, 401k is called a retirement plan. But is it a retirement plan indeed? We don't know. We will find out. So, they are telling you put some amount of your money into your 401k. We will merge it up, and guess what is happening? They will write it off as a contribution, as a company's benefit. They'll write it off in their yearly tax filing. When they file tax, they write it off. But how about you? You don't pay taxes on those money now, but you will pay in future. In future time, that's why it's called deferred tax. In future time, they will charge you almost 55% of what you have in that account. And the problem is, if you try to withdraw it now, you pay a penalty fee, which is 10%, and they will still charge you tax on it. So who's losing? Remember the principle: make money but never lose money. Are you losing or no? You see, that is the problem. So, but you see, account on green, you don't pay tax now and you never pay tax in the future. How good is that? Let's keep moving on. Access to cash penalty free. You see, just exactly what I was saying in the previous slide. Account on green, you have access to it, or your financial portfolios. You have access to your checking accounts now, saving accounts, you have access. You see, life insurance, you have access, stock, you have access, IRA, you have access, depending on how you fund it. But everything on red, you don't have access to it now because you have to wait till maturity, until the maturity time. If not, if you try to withdraw, if you try to get cash from those accounts, you pay a penalty fee of 10%, and not only that, you still pay taxes on those. So are you losing money on those, on the accounts on red? Absolutely. Simple versus compound interest. Albert Einstein said that Compound interest is the eight wonders of the world. He who understands it does what? Earn it. But he who doesn't does what? Pay for it. Let me give you an instance. I own a house. I bought this house at the cost of I think around 363,000, and it was given and I was given to pay off this house for what? For 30 years. Do you know the cost of the house is 363,000, right? Before I can finish paying this house for 30 years, I will end up paying nothing, if not quadruple of the cost of the house. If not quadruple, it will cost me way much more than the actual cost of buying the house. What is happening there? Compound interest. So compound interest is interest upon the principal and accumulated interest. You see what is happening? So, but what about simple interest? Simple interest is only interest on the principal. Interest on the principal. Now let's look at this illustration. Let's say you are given 100,000 and I'm given 100,000. You put your money in the simple interest bucket and I put mine in compound interest buckets. And we are to make 10% interest on these two principal. Let's see how it goes. You on simple interest, me on compound. First, year one, we both make 10,000 interest on 100,000 principal. How about year two? Immediately, I have already started making extra. I make 121,000 and you are making 120,000. Let's fast forward to year five. Uh-oh. Year five, excuse me. Year five, you are making 150,000, and look at what I'm making, 161,000. What's the difference? 11,000. That is compound interest. Now let's fast forward to year 40 so that you see the huge difference. Year 40, you are only making what? 500,000, and I'm already making 4.5 million. You see, simple interest, only interest on the principal, but compound interest grow both on the principal and the accumulated interest. That's why you keep growing. Now, let me ask you, is your money growing by simple interest, or is it growing by compound interest, or is it even growing by any interest? You see, that's the question we never sit down to ask ourselves. But I know, obviously, having seen this, that a lot of us would like to grow our money in compound interest. So let's take a look at compound interest. Uninterrupted compounding. You see, every account, every financial portfolio in checking account, saving account, CDs, 401k, IRA, Roth IRA, stocks, Bitcoin, you see, they are represented with yellow, which means they don't grow by compound interest. They don't grow. If you say, okay, stocks or 401k, remember, like I told you earlier, it's in the stock market. What is happening is today you make money, tomorrow you lose. Today you make money, you lose money. So it's just fluctuating. So you don't know, you can't confidently say that I am making money in this bucket. But guess what? Accounts in fixed index annuity and life insurance, you keep growing, you keep making money, you never lose money. How good is that? Someone will say, how true is this? We will find out. Provisional income and dangers of social security taxation. Most people often say, oh, you know what? I already have a plan about my retirement. I have my social security. I have money sitting in my social security. With that, I can take care of myself when I retire. Look at what is happening. If you look below here, you see if you're making between 23,000 to 34,000 yearly, when you are retired and you want to file, you want to request for your social security, guess what happens? They will charge you 55% on taxes on your social security. Now tell me, if 55% of all that you have saved for God knows how many years, if 55% is charged for taxes, remember I told you it's the deferred tax. The same thing is with 401k. 401k social security, deferred tax. If 55% is charged off of it, how much is left? And can you survive with what is left? On the number of years you will live after retirement. Have you asked yourself that question? Accounts here are not affected by social security because you don't have social security attached to it. Now, this is a big question I want us to ask ourselves. How many days or months or years would you survive moving forward if you stop working today?
That's a
Think
good question.
think about that. How
Yeah,
many months forward could you survive if you stop working today?
that's
Right?
a good question.
Okay. And remember when I was listing the 10 points, chronic and critical illness are the number one cause of poverty. What if this any of these critical or chronic illness attacks you one day and you stop working? What happens? I'm glad you're here. You see, this is what often happens when somebody falls ill or when somebody is experiencing any critical or chronic illness. One, they will request in their workplace. They will request for what? For what's it called? I think short-term benefits. The company usually give them short-term benefits for 3 months. They give them financial support for their medical health for 3 months. And after that 3 months, if the sickness persists, what happens? They will go again and request for financial benefits. And then they'll give them long-term benefit for another 3 months, which is 6 months total. They use that money to take care of their medical bills. But what if this critical illness persists? I don't think the company will be that charitable enough to keep paying for you because one, you're not contributing into the company anymore. You are there as what? As a consumer. So they will tell you, you know what? I think we have been so charitable enough to support you, but now, please, you go take care of your medical challenges. We will welcome you anytime you feel better. We will welcome you. We will put you back into work. Now, what happens to you? Have you recovered? No, you're still sick. Is the hospital still demanding for medical bills? Obviously, they are. Guess what happens? You say, okay, what's your alternative? You go to the government. You request for medical help. Guess what the government will tell you? The government will say, okay, bring your social security. Let's run your social security. They run it, they see that, oh, you have money sitting in your checking account, you have money sitting in your savings account, you have mortgage, you have houses, you have cars, you have properties, you have business going on. They will tell you, go sell those things. Use those money and take care of your medical bills. Only when we see that you are not able to take care of yourself anymore, then come back to us. We will take care of. We will help you. Guess what is happening now? You will exhaust every money you have sitting in this account. All this money, you will exhaust them. That's why it is called the number one cause of poverty. You exhaust them, and when you exhaust them, you might end up with nothing. But guess what happens? The money you have sitting on this account, life insurance and annuity, can help you solve your medical issues, and you still have something left off. How good is that? Let's keep moving on. Okay, now we talk about how good now life insurance is. Some people might be confusing uh, uh, different kind of illnesses or different kind of illness. There are some that are called chronic and critical illness, and there are some that are just what disability. You see this woman sitting, standing on the right. She is only disabled, which means she just have only a minor injury that she can easily recover within 3 months and go back to work. But you see this man sitting, lying down here on the bed. He is passing through God knows what kind of critical illness. And do you think this man will recover in a short period of time? It doesn't look like that. So once what is defined as critical illness is something like a heart attack, stroke, cancer, paralysis, organ transplant, when you're having any of this critical illness, it depends on the type of life insurance that you have. If you have the type that have a living benefit, you will be receiving up to $500,000 to take care of your medical bills, and you still have something left over. So if you have an illness that will hinder you from performing any of the two of the six living benefits, like dressing, eating, toileting, bathing, or transferring, any two of these daily life activities you cannot perform, you can request for financial help from your life insurance. They will give you. That means you have a living benefit. Most of our people have always have this in mind, that when you talk about life insurance, it's only to the dead. It's beneficial to their loved ones after they have passed away. Wrong. We have life insurance that have living benefits, that you can actually benefit from it even while you are alive. And that's the good news I'm bringing to you today. So, estate and probate court. The problem, it's let me explain this. Estate and probate court. Once an individual is pronounced dead in the hospital, that is where probate court's journey begins. What the nurse does is the nurse informs the family members that, hey, your loved one has passed away. Obviously the reaction, right? Everybody go now thinking, how do we take care of this, our loved one? How do we take care of the disease? And another thing the nurse does is they inform the funeral home to come and take care of the corpse, and the funeral home is obliged by law to report it to the state that someone has passed away. And when that call is made, look at what happens. The account of the disease is what is frozen. Everything. So now let me show you the accounts that has been affected. You see every account here on red is all frozen. Sorry. Every account on red, excuse me. Every account on red are all frozen, which means you cannot have access to it, even though you are the wife of the disease or you're the husband of the disease. Even though two of you do a share joint account, you don't have access to it because it has been frozen. What happens is that they will start up a probate court process. So now this is what probate court does. Probate court is a system that tries to use the account, what the disease have in the account, to settle up all the estate. The estate means all the debts that the disease is owing when he was still alive. All the debts they are owing. It could be a mortgage, it could be a car loan, it could be a student loan, it could be a credit card. So all the debts that he or she is owing before they pass away is what we call estate. When the person is alive, it's called bills. But when the person passes away, it's called now estate, because it's a collection of all the debts they are owing. So the probate court system will kick off usually between 6 months to a year. That's when the process will begin. And usually you don't know how it lasts, because you know how court process lasts. Sometimes it takes 2 years, 3 years, 4 years before the case is finalized. All the debts are being paid before even the loved one will have any money left over that they can use. But how about if if all the money in the account is exhausted and yet the bills are not all paid? What happens? That means the loved one has nothing to live off of. You will start life all over. Every account here on red is being affected by the probate court. But the account on green is never affected because they have a different tax code. How good is that? It's getting interesting, right? Awesome. All right, so let's move on. So this is the summary of everything we have been discussing. How you make money and how you keep money, how you are not losing money. What accounts do you have that you're making money, that you're not losing money in, and that you're making money? Here, if so, let me ask you: if this happened to be your report card, which one would be your best subject?
Huh. I see the life insurance
Okay, and why did you say? Why did you pick life insurance?
because there seems to be the freedom in one the compound interest, the freedom, and you can still have your money, like even if like now you're contributing, if you decide to withdraw from it, they will not hold your money.
Absolutely, well answered. You see, it's all checked on green, which means any of these any of these factors listed above does not affect it. Your money continue to do what? To grow. Now, if I may ask you again, what will be your worst subject, and why did you choose that?
you, the worst subject. I'm thinking of 401k. Actually, I used to think it's good, but depending on all the system, the way it works, the taxation, because you'll be thinking you're saving, but at the end of it, you will lose it.
Absolutely. You
Mm-hmm.
see, all the factors we mentioned above, you see, it affects the 401k. That's why it's all on red. Even the inflation, you see, some on yellows, which are not guaranteed. See, 401k IRA, they are not guaranteed, right? And I know beyond reasonable doubt that you would like to know much further about life insurance and how you can benefit from it. Is that correct?
Yeah, that's correct.
Okay.
What would be your worst subject? Can you tell us? And what
As,
would be the best?
just as you mentioned, that will be my worst subject. The 401k, the IRA is something I want to avoid, and I want to put my money where I know I can benefit from it. That's like
Absolutely.
the life insurance that is all green, because I know if I put my money in there, it is safe and it is growing. So, with that being said, let us look into life insurance. Okay, growth option on your money. Growth option on your money. So let me ask you real quick. How would you like your money to grow? Man, looking at these three diagrams before you, how would you like your money to grow?
I would choose IDEX.
Index. Well,
Uh-huh.
and why do you choose index?
Um, First of all, it seems to be like it's not more of a constant, but it's the graph is going up, up, up. If you look at the variable one, it seems unstable. Fixed
Mhm.
one, it seems more of the simple interest.
Okay, well said. I will be so glad to explain to you, and I'm glad you made the right choice because that is growing exponentially, and every other thing here is not doing just as the index account. Okay, now fixed. What uh, what are the type of accounts we find in fixed? You see, what we have in fixed is something like your checking account, your saving account, your CDs. These are features, these are characteristics of the fixed. Why? Because you put it there, it doesn't grow. It doesn't grow. How much do you make as a profit? How much do you make as interest in your checking account? I know my own. I know the last time I checked my account, it's only 0.01%. That's what the banks gives you as an interest. At most, they will give you 1%. Is that a growth? It's not growth. That is a staunch growth. That's why you see it moving at a low pace like a snail. It doesn't grow. So coming to variable accounts are accounts that are not stable. They are not reliable. They are always changing. They're always changing. Today you rejoice like, hey, I made profit. Tomorrow everything crushed down. Accounts you find in this are like your 401k, IRA, 529, pension plan. These are the characteristics of the account you find in this bucket. Now, let me ask you. Let's say you go to buy your most favorite car, your best car, the car that you love, and you go to the company to buy that car, and the company tell you, "Oh, we actually have the car, but it's not reliable." Would you still proceed to buy that car? Is that
Absolutely not.
so? Why won't you buy it?
Like, if the car is not reliable, that means you want to look for something that is stable, that, let's say, maybe you're going somewhere and then on the road something is blowing up. Yeah, so you want something reliable. Yeah, that's what I would say.
Thank you. Good answer. You see, it's not reliable, which means it can stop you on the road. And by that time, you start calling what? Triple A, right? You don't want that. But guess what? That is what we're doing. We have our money in stock market. We have 401k. We have IRA. Today it's growing. Tomorrow it depreciates. Today it rise. Tomorrow it falls. Today it rise. Tomorrow it falls. That is what our money is doing. But look at index. Now let me explain to you what index does. Index Index takes advantage of the upper potential of the market and locks it. So it credits your account when the market is doing well. When the market is about to fall, it locks it so that you don't experience what? You don't experience downfall. So invariable, it takes into consideration both fixed and variable. It takes it to grow, and it locks it so that you don't experience what? You don't experience downfall. Your money doesn't you don't lose money, but rather you keep what? Growing. You keep making money and keep growing. You see, that is, and the type of account you find in this bucket is what is your annuity and life insurance. And now is the topic everybody will say, I don't want life insurance, is only for the dead. But guess what? Is the thing that most of the affluent use to grow their money, and yet they are living. So let me ask you a quick question. If I can show you how to transition from the fixed and variable into index annuity, it has a clause. If only you will qualify. If only you will qualify. Is it something you want to consider, or you want to go think about it?
Seems like something you can do.
Absolutely. I know
Yeah.
everybody will want to embrace it because nobody wants to lose money, right? Nobody wants to lose money. Everybody wants to grow. You don't want
Uh,
to walk.
Actually, I can add a comment on that. Thank you. Actually, thank you so much for bringing this one. Because I was listening to someone and they're saying the American, most of the white people, they built the generation wealth using their life insurance. By the time, like, it's like passing for them, it's a culture that
Mhm.
they keep passing on to their children and their children's children. So that's why you don't see them struggling with the funnels. By the time someone is on the college, they already have the money or those kind of things. Anyway, let me not cut you.
Thank you. That's exactly what they're doing. And that's what we are introducing to our community. And anyone who wants to be a beneficiary of it, it is open. You all can make it. You all can do it and grow your money without losing anything. So, with that being said, let's talk about life insurance. Now, some people will say, "Oh, I have life insurance. I have life insurance." But what kind of life insurance do you have? There are four types of life insurance. We have what we call group life, we have term life, we have whole life, we have universal life. Let's look at them one after the other. Group life. This is the type of insurance you get from your workplace. It is significantly free because you're not paying for it. Your company is paying that for you, and it can be given to both full time or part time employees. Now it only have two advantage, but look at number of disadvantages it has. One, coverage ends when you leave your job. Is that reliable? When you leave your job, that's when coverage ends. How long do you think you will be in your company? How long do you think you'll be with your company? That's one question you need to ask yourself. Excuse me. The next point is it's a paid only upon death, mostly at work. That means you have to be on the job and die in the job before this life insurance will be given to your loved one. You don't have to be in your you don't have to die in your work in your house. You don't have to die on the road. Even though you get to work and you're in the garage and you are not inside the workplace, it's not considered. So you see the limitation. So you have to die in your workplace. You have to clock in. And do you know when you will die? Do you know if you will die in your workplace? That's a question to think about. It said no benefit to clients while alive. It doesn't have living benefits. This type doesn't have living benefits. And you want something that have living benefit that when you are alive, you can benefit from it. Illness, layoff, retirement result in end of coverage. So when you're ill, you're laid off, you retire, that coverage ends. You're not part of the company anymore, so they have nothing to do with you. So most times the payout probability is 0.9%, which means it doesn't always pay off. So it's deceptive and all of those. Moving on. Now, term life insurance. We have term life insurance is very cheap. It is the type that is very popular because it's announced on TVs, banks, audios, and everywhere. But what is the disadvantage? Just as the name implies, term. Term means temporal. It's a temporal coverage. It can be 10, 15, 20, 30 years. What happens if you elapse the duration of time you apply for this policy? If let's say you bought the policy for 20 years, and after 20 years you didn't pass away, you didn't die, what happens? The whole policy is gone. The whole money you've been throwing into that account is what? Gone. Think about that. Only paid upon death, which means you have to die within that duration, within that period of time. No benefits to clients while alive. It doesn't have living benefits. So if anything should happen to you and you want to request for maybe you have health medical issues and you want to request for it, no, it won't be given to you. Premium will increase where policy terms. So if you have a 20 years policy and it ends and you want to renew the policy again, what happens? It will quadruple. Why? Because your age has increased. And one thing with policies is it is calculated based on your age. So if you attain the age of 65 and you want to let's say you bought this policy at age maybe 30 and you bought it for like 20 years, the next year will be 50. When you want to renew the policy at age 50, it will quadruple because your age has increased. That's a disadvantage. Lapses if payment is missed. So let's say you bought your policy for 1 year, you bought your policies for 20 years and you only paid for 1 year and you miss the next year. What happens? Everything terminates. Or you pay for up until 19 years and you miss 1 year. Everything you paid for is gone. It terminates. No cash accumulation. Is gambling by betting against your life. That means you are just throwing your life at the stake. You are gambling with your life. Because nobody is sure of when they will pass away. You don't know if you will pass away within that time frame. So it's better to make a wise choice. Whole life. Advantages of whole life is it gives room for up until 100 years. Premium remains the same. So the premium, let's say you bought this policy at the age of 20, it will remain the same all through up until year 100. If you live up to year 100, it remains the same. Cash accumulation, maybe there are some that accumulate cash and there are some that do not accumulate cash. But what are the disadvantages? It is very expensive, more expensive. No benefit for clients while alive. It doesn't have living benefits. So no cash value guaranteed. Death benefit without cash value. So when the policyholder passes away, the beneficiary can only receive the principal without the accumulated benefit, without the compounding interest attached to it. You only receive the principal. So you ask yourself, which one is better for me? Now this is index universal life insurance. This is what we call the family miracle. This is the ultimate of everything. It has up to 62 benefits that I will show you in the illustration. But what are the disadvantages? Pass a health physical. That means you must be healthy. You must be healthy to be able to obtain this policy. Then the second disadvantage say it sounds too good to be true. Yes, it sounds too good to be true. So now let's go over to the illustration to see the benefit of this index universal life. Benefits of index universal life. Now I will use an illustration of let's say we have a female. She's living in Texas, and let's say she wants a $1 million policy, and she wants to be paying the policy for monthly. So this is the policy value. She applied for $1 million, and this is what she will be contributing every month, for her policy annually. Okay, this is what she can pay annually if she wants to, and then but overall in a year, this is how much she can put in her policy value. Overall in a year, this is how much she can put. Now, how much has she? How much can she contribute annually? She can contribute 7,800 if she's going by this amount. If she's going by this, but remember, she can do this if she's doing 7 pay. Then, how much does she have in her policy value? She has 5,176. How much can she take out? Zero. I know someone will say, oh, okay, how come she cannot take out any amount here? One, this company has had experience of, people coming in and they start sorry, excuse me. They start the policy and they immediately start requesting for money. It depends on what you are investing in that will guarantee if you are getting more, if you are getting something out immediately or you're getting something down the road. If you're starting small, well, the company wants to make sure that they can trust you to do business with you before they can say, okay, we can actually give this person because he trusts on us to put his money into this investment. So, but and this is what if anything happens to you from the day one, like let's say from the first month you invest into this account, and anything happens to you in the first month, your loved one is going away with $1 million. How much has this person put in? Only 7,810, and the loved one can go away with 1 million in just 1 month of signing the policy. If anything should happen to you, have we thought of that? This is just like a free money that you just bless your loved one with without nothing. Think about that. Again, remember, okay, like I said earlier, we are talking about the benefit of this index universal life. What are the benefits? Now, the very first benefit is compound interest. Remember, I said that compound interest is the eight wonders of the world. He who understands it does what? Earn it. And he who does what? Pays for it. This is where your compound interest grows. The money you have in your policy value, right here, that's where you have your compound interest growing. Sorry, I don't know what my system is doing. Okay, so you see, here in your policy value, your money grows. Let's take, you see, year one, how much has she contributed? 7,810. And how much can she take out? Zero. Year five, how much has she contributed? 39,000. How much does she have in her policy value? 29,000. How much can she take out? 8,000. Let's see year 15. Year 15, how much has she contributed? 117,000, right? How much does she have? 130. How much can she take out? 130. Now, can you compare how much she has contributed to what she have already in the compound in her policy value? No, she is already having 130 compared to what she invested. And how much can she take out? 130 compared to what she invested. Now let's look at age 65. Age 65. How much has she contributed total? 257,000. How much can she take out? Five, how much does she have in her policy value? 580,000. How much can she take out? 580,000. How about how about age 75? Age 75, she has only contributed 335,000. How much does she have in her policy value? 1 million. Is this two amounts the same? How much she put in and how much she can take out? Look at that. She has 1 million in her policy value and she can take out 1 million. How good is that? That's compound interest. It grows by compound interest. I know you don't have, most of us don't have an account that grow by compound interest. Here it is. You can grow your money by compound interest in this account. Now, what is the second benefit? Probate court-free debt benefit. You remember what I talked about probate court. When somebody passes away, and you want your beneficiary to have everything you have left off, and it's being frozen by the probate court, right? Guess what? This account never got frozen. That means at any point in time that you passes away, any whichever level, either is age 38 or it's year 6, whichever way, the money you have in this account will be transferred to your loved ones without passing through the probate court. Remember, the probate court might take up to 2 to 3 years before it is being finalized, and anything left off will be given to your loved ones. But this one, it's not passing through that probate court. Everything you have here will be transferred to your loved one. How good is that? That's another point. That's another benefit. Another benefit is tax-free death benefit. The same amount will be given to your loved one tax-free. He's not paying 55% of anything. He's not paying 20%. He's not paying 100% of anything in tax. Everything will be given to your loved one free of charge, not deducting anything. How good is that? All right.
Amazing. Mhm.
That is another benefit. And remember, I told you about the number one cause of poverty in our nation, critical and chronic illness. And we're talking about terminal illness. When the doctor pronounces that you have only 12 months to live, that means your condition is becoming so critical. Guess what? They will give you 100% of the money you have sitting in your policy. 100% meaning how much? $1 million will be given to you. Even though you just start up this policy in 1 year or less than 1 year, 6 months or 5 months or whatever, and you are and the doctor says that you have only 12 months to live, 100% of this amount will be given to you. Have you not become a millionaire overnight? Awesome. Another one is critical and chronic illness. These are the benefits. These are what you stand to gain. And I know that even over the years that you have worked, you've not been able to save up to 1 million in your account. You can become a millionaire. only by owning a policy. Next benefit, critical and chronic illness, which is the number one cause of poverty. If you have this policy, if you happen to be ill of any of, be it a heart attack, stroke, cancer, paralysis, organ transplant, any of these critical illness, and you can request for medical for financial aid. The company will give you, depending on the policy you have. If you have above 500,000 in your policy value, they will give you $500,000 to take care of your medical bills. If you have less than 500,000, they will give you 90% of what you have in your policy value to take care of your medical bills. I know that most times we work so hard and we don't have up to that amount saved up in our account. You see, and that's why we end up spending everything we have and becoming poor because of critical and chronic illness. That's a very good advantage you need to think about. Another one is access to cash. There are two ways you can have access to your cash here in this your policy. One is you can either once you have gone past this level of year four. Once you have gone past this, you can ask for any amount and it will be given to you. But you don't want to take money that is above what you have in your policy value, right? If not, you will kill your account. You will start all over. But again, there are two ways you can take money from this policy. One is either by withdrawal or by what? By loan. So if you do withdrawal, the money will be given to you from your policy value. But again, you don't want to kill the chicken that is laying your golden egg, because compound interest grows by the principal and the compound and the accumulated interest. So which means every amount you have in this account, that's where your compound interest will accumulate. So if you take $20,000 out of this your policy value, how much is left off? You have $9. So if your money wants to grow now, it will only grow by 9,000. So you don't want to. It's these are the choices you have. So whichever one that seems right for you, you do. But for me, I would prefer the alternative. And what is the alternative? Loan. If you request for loan, the company will give you loan from your debt benefit, which means it will not affect your policy value and your money will continue to grow by compound interest. The only thing that will happen, it will reduce your debt benefit. And hey, it is still your money. If you request for, you have the option to either pay back or not pay. It's your money. If you take your money, if you want to pay back, you pay back into your account. If you don't want to pay back, so be it, right?
Wow, can you explain that a little bit? So let's say I take 20,000 loan from the 1 million.
Mhm.
One, will I have interest?
Absolutely. So, interest depend on the interest, your interest rate. Let's say you have a 7% interest that your account is growing by. If you take out 20,000 from your debt benefit, it has already affected your interest rate. If your account is growing by 7% before, now you have reduced it by 2% because you took out the money from your policy, right? So now it will be growing by what? By 5%. But if you happen to pay that money back through your policy, through your premium, it grows back up, it comes back up to that 7%. Does that make sense? So it just depends on how you want to treat it. If you want to take it and return it, it will bring you back to what your interest rate used to be. Does that make sense? All right,
Yeah.
that is access to what? To cash. You have access to take money from here. You see, that is the living benefit. While you're alive, you can take money from your policy. Another one is autopilot. Let's say now that you feel like you want to pay this money up to some certain years and then stop paying. Let's see how that works, or let's see how that applies. Autopilot. Autopilot, let's say this lady wants to stop paying at year 40. She wants to stop paying at year 40 and then let the account grow by itself. Let's see what happens. You see, at year 40, she has stopped making contribution into this policy. Look at how much she has contributed so far, which is how much? 312,000, right? That is it. She never contributed any other money into this account for the past who knows how many years. But look at what is happening. The money continued to grow. Look at her policy value from from 912,000 to 969 to 1 million, and it kept growing. It kept growing up to 5 million, up to 7 million, 8 million, 10 million, 11 million. And she can take out the same amount regardless of where she have stopped making contribution. The same thing if she passes away, let's say she passes away at age 75, what happens? Her loved one is going away with 1.9 million. Did you see that? And she stopped putting money at year 40, the money keep growing. This is what we call autopilot. It's different from what? From term policy, which when you stop making payments, what? The account terminates. You see that? That is an added advantage. Another advantage is what? Flexibility. You know, all along we have been talking about what? Monthly contribution. How about if she wants to do a yearly annual contribution? Now take note of this amount. You see, at year 4, she can only take how much? $2,040. And but she is entitled. So if you add up this amount, this $655 for that's monthly. If you add it up to a year, it amounts to this. It gives us this amount, 7,810, right? And but because she's paying monthly, look at how the account is growing. It's growing gradually. It's growing regardless, but it's growing gradually. How about she switches over to annual payment? Make one-time payment for the year, and that's it. I love annual payments. And again, there's another alternative to annual. So we switch this premium mode from monthly to annual, and let's see how it works. See, before, remember what she could take out as year 4 was 2,040. Is the same amount she's contributing, but now she decided to pay everything in one time. She decided to pay one-time payment for a year, and that's it. Let's say you just only paid January for the entire year. You're not making any other contribution. So any other money you have, you can use it to take care of your other expenses, house expenses, and all those stuff, all those good stuff. But guess what? Your account is growing exponentially. In fact, it grows even much more. That is growing much more than the monthly contribution that you're making, because at year 4 you can be able to take out how much? 3,575. And how much has she contributed? The same amount every year. So how about there's another option of doing 7 pay. Let's see 7 pay. If she decides to say, you know what, I have money sitting in my account, I just want to put everything at once. I want to put everything at once instead of doing this small monthly payment. I want to do 7 pay. Let's see 7 pay. She decided to put how much? The entire $54,209 into her policy. Guess what happens? From day 1, From day one, she can immediately be eligible to take out $32,000 from that policy. And the money start growing. In fact, she start making million sooner than she expects. As from year 13, age 45, she's already a millionaire. Did you see that? That is a benefit of what autopilot and flexibility. You can decide on how much you want to be putting in. The most important thing is have your money grow for you while you are doing other stuff. You're doing other stuff, managing other business, and your money is here growing for you. You're meeting up with life expenses. How good is that? That's flexibility. Another one is income for life. How about she wants, let's say at retirement, she doesn't want to do anything else. How does she survive moving forward? There is something we call income for life. This account will start paying this woman from the moment she says she wants to be taking money from this account. Okay, I will switch it over to our normal target premium, and she wants to start taking money from this account at age 41. And she wants to be taking 50,000, right? Let's see. Income for life. That is advantage of this policy. So remember, she said, I want to stop paying money into this account at year 40. And she did. And now she said, okay, I want this account to be paying me. Now the account will start paying her 50,000 every year. Annually, she'll be taking 50,000 from this account. How long, how far can she benefit from this account? Let's see. Up until age 100 and up until age 101. Now let's do the maths. Let's do the maths quickly. Age, let me see. Let's use the year. Let's say year, that's year 69, right? Year 69 minus 40, 29 years. This account will pay her for 29 years, $50 until she passes away. And if she, maybe, who knows, if she lives up to that, or if she lives less than that, she still have money left over that she can give her loved one. Did you see that? That is what we call what? Income for life. It will pay you and you still have something left over. So if you retire, you retire and relax. Excuse me. You relax because you have a backup. She already have a backup set up that will pay her. So she doesn't have to worry about anything else. I know she might have maybe she have other source of income, but this one is guaranteed for her. How good is that? Income for life. Another thing is $1 million baby. I know I talked about that earlier, but let's see how it works. Let's say you have a baby and you sign up for this baby. You sign up for this baby when he or she is 2 weeks old. Look at what happens. Let's switch this to monthly payment. Okay, and let's take out this. See, that's why I said this is what the affluent use to take care of their children. That's why they never talk about taking student loan. When you're talking about student loan, it's not their business, it's not their worries. Why? Because they have made preparation ahead of time for their children. That's why their children can go to any higher institution of learning and they can confidently take care of the bills because they have made the plans for them. Look at that. Monthly, the parents can pay $314 on this policy. Guess what? The policy start growing. Let's say the child wants to go to college at age, let's say age 20. The child is now qualified to go to maybe Harvard University. Look at that. They already have $87,000 saved up for this baby to go to college. Won't this child be able to go to college without taking student loan? There you go. What if they want to grow their account for the baby at age 55? Age 55, this baby is already a millionaire. Did you see that? This child has nothing to suffer anymore because the parent has prepared the foundation. They have prepared a solid foundation for this child to ride on.
I have a question.
Please go ahead.
So, for those account that all the different types of system that we can use or we can select from, can you combine like for the $1 billion, for the seven pay? Do they have like option for combining them, or you have to do it separately?
To the best of my knowledge, I think it can be done separately. That's why it is optional. You know, you have different options. You can do if you want to do a combine, you that means you want to have two different policies, and which is open and is acceptable. You can have and you cannot have policy for you and your child. No, it has to be by individual. So you can, if you decide if you want to go by 7 pay, you can, and you want to do it for yourself, you can do it for yourself. And if you want to do it for your baby, you can do it for your baby. You want to do it for someone else, your relative, your loved one, maybe your husband or your wife, you can do it for them. You can have for yourself using 7 pay. You can start another one for your husband and use maybe annual payment. So you can do it in those ways. Did I answer your question?
Yeah.
Absolutely. So again, this is I would have loved to run an account for you, and I know this is so much interesting. It's something that will benefit our community, and so if you are interested, please give me a call. Terry here, my very good friend and partner, she will be giving you every detail about me. You can reach me if you are interested in preparing for your future, preparing, and having a very good retirement plan set up, or something for your baby that you want your baby to be debt free in terms of student loan. This can be a very best way to invest in your baby, that they can have something to start life with and have a smooth sailing life. But again, there are questions like you remember when I was talking about how to grow your money. There are questions that are key that you must, that will determine if you qualify for this policy. Those questions I will leave it up now. So when we come in contact, I will ask you those questions. It will determine if you're qualified, but I trust you will be qualified. So um, Terry, this is basically all I have to offer, and I wish and I know that this will be a blessing to so many of us in our community, and I'll leave it up to you.
Okay, I was on mute.
Back to you,
Thank you
Terry.
so much, Onika. This was a wonderful presentation. Actually, I have learned a lot from it. And I hope my listener have enjoyed. You would like to know more on this, please let me know. I can connect you with Onika. He's my good friend, and it will be my pleasure for you to serve you. So let me know if you need his contact, so you can contact him directly, and he will be able to explain more and answer your question. Thank you so much, Onika, for honoring this invitation. Thank you so much. I really appreciate you.
Thank you so much. It's my pleasure, and thank you for having me.
So, guys, as you have heard, that is Onika. Please, if you are interested in this, and knowledge is power, and it's always good to empower yourself. And yeah, I hope you enjoyed this video. Let me know what you think. Please subscribe if you haven't, and I'll see you next. Okay, bye bye.